Vice Chair Quarles, never have I been so happy to see you. Oh, you're on mute.
We're having all kinds of technical difficulties here. I hope this will work. So
I hope so too. But we can see you and we can hear you, so that's great. And so while the Zoom gods are shining on us, we'll jump right in. Welcome back, everyone. It is my distinct honor to introduce the Vice Chair for Supervision of the Federal Reserve, Randal Quarles. Vice Chair Quarles has served as a board governor and Vice Chair for Supervision since October 13, 2017. He also chairs the Financial Stability Board, where he took office in December 2018. Prior to his appointment at the Fed, Mr. Quarles was founder and managing director of the Sinosure Group, a Utah-based investment firm, and before that, a partner at the Carlyle Group, a private equity firm in Washington, D.C. The Vice Chair has a long history in public service, 3 stints at the Treasury Department as Undersecretary for Domestic Finance, as Assistant Secretary for International Affairs, and as a Deputy Assistant Secretary for Financial Institutions, as well as serving as the U.S. Executive Director of the IMF. His private and public sector experience makes him uniquely qualified to shepherd through a robust agenda as the first Vice Chair of Supervision. Thank you so much for allowing the IIB to be the venue for your remarks today. We are truly honored and look forward to hearing from you. With that, it's all yours.
Thank you, Bridget. Am I at least audio? Is the audio clear? Okay, great. Thank you. Thanks all of you for your patience with our technical issues very much. I want to thank the IIB for inviting me to discuss the outlook for the global and U.S. economies right now at what I think is an important juncture in the evolution of what I refer to as the Covet event, meaning the outbreak of COVID-19 and the government and social response to it. So first, I'll discuss the global economy before turning to our domestic economy and its outlook. And from there, I'll discuss my views on monetary policy, including the new long-run monetary policy strategy recently announced by the FOMC. And I'll wrap up with a brief discussion on financial stability and regulatory issues. Let me start with a picture of the global economy. Although challenges remain, especially among some emerging market economies, significant support to households and businesses from central banks and fiscal authorities has contributed to a strong rebound in a number of advanced and some emerging Asian economies since those countries began to loosen restrictions. In these economies, the reopening of factories has led to a resurgence of industrial production. Retail sales are rebounding. In some countries, they're already above levels that were seen before the COVID event. But international trade has been slower to increase. The extent of the recovery in some jurisdictions has been surprisingly robust compared to many analysts' expectations earlier this year. And that momentum is feeding into many private sector forecasts that suggest prospects are good for strong economic growth in the United States and other advanced economies over the rest of this year and next. But the hole that countries are in remains deep, and significant downside risks still exist. Perhaps the most discussed risk has been that a second wave of the virus could trigger a return to widespread mobility restrictions and business closures. Several countries, including some portions of the United States, have seen a substantial resurgence of infections in recent months. This has been accompanied, however, by substantially lower hospitalization and death rates in most cases. And so far, most countries have been able to address the resurgence without reinstituting severe restrictive practices. Mobility indexes have been little changed in Europe and the United States. The declines in Asia have been modest. Businesses, which have adjusted operations and in some cases changed business models, seem much better adapted to remaining open. I'm also hopeful that better testing, tracing, treatment regimens, as well as improved understanding by the public about how to manage the risks of the disease will allow firms, individuals, and governments to address public concerns about the virus while avoiding a second severe downturn or a protracted stagnation. Still, the economic fortunes of households and businesses around the world remain at risk. Incomes and employment are likely to lag below pre-COVID event levels for some time, which would put stress on the finances of many families. Some people may remain reluctant to return to full engagement in social and economic life, weighing especially on the service sector. Even with support from monetary and fiscal policy, large numbers of businesses may close. These closures may lead to some longer-term scarring of the economy through lower investment, reduced capacity, and long-term unemployment, leading some to drop out of the labor force altogether. While I am optimistic that recovery is underway and the worst outcomes can be avoided, these concerns suggest that policymakers around the world need to remain watchful and ready to act further. Now let me focus on the US economic conditions and the outlook. The historic collapse in economic activity in March and April will take time to reverse, but the economy has rebounded more strongly already than almost any forecaster expected. That resilience reflects the economy's underlying strength upon entering the recession and demonstrates its inherent flexibility, as well as the dynamism of the American people. For example, the Census Bureau reports that applications by people seeking to start new businesses have surged this summer. The median of projections for 2020 by FOMC participants in September showed that both gross domestic product and inflation had been revised up significantly from the median in the June projections. I expect that robust GDP growth over the rest of this year and in 2021 will lead to strong employment gains and move inflation closer to 2%. I would still caution that there's an unusually large amount of uncertainty now about any outlook, and I see the risk to the outlook as weighted to the downside, as the economists say. But given the trends I previously discussed and the way countries are adjusting to the COVID event, I'm optimistic that the United States can avoid the highly adverse outcomes that many feared would materialize just a few months ago. Turning now to the labor market, unemployment was still at 8.4% in August, and the labor force participation rate still down significantly from February. The extraordinary package of fiscal support in the CARES Act helped to support household incomes and to offset the effect of the huge job losses in March and April. But the Act's unemployment provisions have expired, and most of the businesses that received Paycheck Protection Program loans report that they've exhausted those funds. In addition, one area where increased understanding of the disease has, in many places, not led to general changes in practice is in the widespread school closures this fall. Many parents with children will be forced to work less, or not at all, which is going to be a hardship for them and weigh on the economy. So I agree with Chair Powell that it will take continued support to maintain a robust recovery. Now, while still unacceptably high, an 8.4% unemployment rate represents a considerable improvement from 14.7% in April. And there are some reasons to believe that that 14.7% was really being undermeasured. And it's already much lower than many thought possible this year. By comparison, after the onset of the Great Recession, it took more than 2 years to reduce unemployment from the peak of 10% to 8.4%. One reason for the faster turnaround this time is that many of the initial job losses and subsequent job gains were due to temporary disruptions that many businesses have overcome. But some indicators point to slower improvements in the job market going forward. Like employment, consumer spending has been much stronger than expected, even though spending on travel and many other categories of in-person services remains depressed. Retail sales were extremely strong from May through August, driven by demand for consumer durables such as automobiles, furniture, and home improvement. Home sales and construction also have increased sharply since then. For instance, new home sales rose in July to an annual pace of over 900,000 units. That's 16% above the recent peak in January of 2020, well before the COVID event, and the fastest pace since December of 2006. All of these facts lead me to believe the momentum in household spending is strong. Although consumer confidence remains lower than earlier this year, the resilience in big ticket purchases indicates some underlying confidence among households that the economy will continue to improve. The strength in the consumer and housing sectors is being supported by Fed action to lower interest rates and support credit availability for creditworthy borrowers. In addition, the recent high rate of household savings likely represents a significant source of pent-up demand for the future. Now let me turn to the business sector, where the picture is more mixed. As in the household sector, the decline in many measures of business spending last spring turned out to be much less than was feared, and some indicators of business investment have turned around dramatically in recent months. But there is considerable uncertainty over how businesses will deal with the cumulative effects of the COVID event on the economy. As we all know, medium and small enterprises were, and continue to be, heavily affected by the COVID event. The PPP disbursed $525 billion in loans to businesses through August 8th, most of which will be forgiven when businesses are found to have met the requirements for keeping workers on the job at previous pay rates. Working with the Treasury Department, the Federal Reserve created several facilities that are providing support to large, mid-size, and small firms. These programs have improved credit market functioning both through direct support to borrowers and, equally importantly, lenders indirect support by creating a backstop against worsening conditions that boost the willingness of private sector lenders to extend credit. Despite those efforts and the pickup in household spending, many businesses are still under strain, representing an important source of downside risk. One concern is that many businesses already were highly leveraged going into the crisis. Taking on more debt as a bridge until commerce normalizes may not be a viable option for some of them, even with favorable repayment terms. Many corporate bonds and leveraged syndicated loans were downgraded between March and June. Default rates on corporate bonds rose significantly over that period as well, but corporate defaults have slowed in the past couple of months. And so far, delinquency rates on business loans at banks, as opposed to bonds, have increased only marginally. This development, in part, highlights banks' ability to work with borrowers that have been hurt by the COVID event, as laid out in supervisory guidance provided by the Fed and the other federal banking agencies. Another downside risk in the business sector is the strains to commercial real estate, particularly in retail and hospitality properties. CRE was a prominent concern before COVID, although one that seemed quite manageable. Since then, vacancy rates have risen significantly, rents have fallen sharply, putting at risk the high valuations that our May financial stability report flagged as a vulnerability. The sharp decrease in output and employment, as well as continued slack in the economy, have put downward pressure on wages and the prices of goods and services affected by the COVID event. The 12-month increase in the price index for personal consumption expenditures dropped to about 0.5% in April. And although the recovery since then has helped prices retrace some of those declines, PCE inflation was still only 1% for the 12 months that ended in July. It's likely to end 2020 well below our 2% longer run target. And indicators of future inflation don't seem to point to rapid acceleration. Market measures of inflation expectations decreased sharply earlier this year before recovering to their previous levels recently. And inflation expectations in some surveys of professional forecasters have ticked down. The FOMC will be closely watching for a further recovery of inflation and signs that inflation expectations remain well anchored as we set monetary policy. Now, in the near term, with both employment and inflation significantly short of the FOMC's economic goals, the prescription is for a sustained aggressive use of monetary policy to support the economy. In March, the FOMC cut the federal funds rate effectively to zero and began purchasing large quantities of Treasury and agency mortgage-backed securities. Over the following weeks, the Federal Reserve Board used our emergency authority to establish 13 lending facilities to provide support to households, financial firms, non-financial businesses, nonprofit organizations, and municipal governments. We also took steps, including extending dollar swap lines to other central banks, to address strains in global dollar funding markets. Taking a step back, beginning in 2019, well before these recent events, the FOMC undertook a public review of the conceptual framework for how we approach monetary policy. And last month, the FOMC updated its statement on longer run goals and monetary policy strategy, which we call the consensus statement. I want to emphasize the very public and deliberative nature of this policy review under the leadership of Chair Powell and Vice Chair Richard Clarida. Through a series of 15 public Fed Listens events, we received input from a broad spectrum of people, small business leaders, union workers, retirees, prominent outside researchers, and others. The FOMC also had the benefit of extensive research and analysis from Fed staff and debated the issues at a series of FOMC meetings. This process set a new and very high standard for transparency and accountability for the Fed, and we have committed to conducting such reviews roughly every 5 years. I believe the new consensus statement lays out a strategy that's suited to the demands of setting monetary policy in our constantly changing economy. Let me begin by focusing on 2 key conclusions. First, over the past 2 decades, the prevailing level of interest rates in many advanced economies has declined, leaving central bankers with less room to cut interest rates when the economy slows. In addition, experience over the past few decades has shown us that the traditionally strong relationship between unemployment and inflation has weakened, perhaps considerably. We saw this weakening relationship in the United States as the robust expansion before the COVID event led to historic and broad-based labor market gains. Not only did the unemployment rate drop to long-time lows, but the wages of low and moderate income workers also accelerated, and unemployment rates for historically disadvantaged groups fell to record lows. Yet inflation continued to run modestly below our symmetric 2% target for almost the entire period, and long-term interest rates remained very low by historical standards. This recent experience in the United States, which has also played out elsewhere, has led to a growing consensus in the economics profession that the relationship between unemployment and inflation, commonly known as the Phillips Curve, has flattened. And therefore, given the considerable benefits that we observed when unemployment fell to very low levels in recent years, the committee determined that a low unemployment rate, unless accompanied by worrisome developments in inflation or other risks that could impede the attainment of our goals, would not necessitate a policy response. We captured this change in the revised consensus statement by tying future policy decisions to shortfalls of employment from its maximum level rather than to deviations from the maximum level, as in the previous statement. The new framework statement also highlights that the maximum level of employment is a broad-based and inclusive goal, and it reiterates that the committee will review a wide range of indicators, not just the unemployment rate, in its assessment of that level. I believe these changes to the way the FOMC responds to labor market conditions will result in a stronger economy without jeopardizing our commitment to low and stable inflation. In fact, I think that meeting our longer run goal of 2% inflation, as defined by the 12-month change in the overall PCE price index, which is unchanged by this revision, will help achieve the kind of labor market outcomes that we've experienced in recent years. And that's a good segue into the other major change in the consensus statement that I want to address today. Even before the COVID event pushed inflation down to very low levels this year, PCE inflation had been running modestly below 2% for some time. And some measures of inflation expectations had decreased to the low end of their historical ranges. These developments certainly bear watching, especially if inflation would remain lower than it had been in previous years, or if inflation expectations were to decrease further. A decrease in inflation expectations can lead to a downward spiral in actual inflation, which would further reduce already low equilibrium nominal interest rates, and among other consequences, leave the FOMC with less flexibility to address future economic slowdowns. In order to better anchor long-run inflation expectations at 2%, the consensus statement makes a distinct change from the old approach. The committee will seek to achieve inflation that averages 2% over time, which means that we'll aim to achieve inflation moderately above 2% for some time, following periods when inflation has been persistently below 2%. In the previous consensus statement, the FOMC committed to a 2% longer run goal for inflation that was to be symmetric. This wording already suggested some tolerance for inflation above 2% when it was consistent with meeting our employment mandate, and I certainly never viewed 2% inflation as a ceiling. One reason to be comfortable with inflation at times running moderately above 2% is that defining and measuring inflation are very much an inexact science. For that reason, I've always considered alternative indicators of inflation, such as the Dallas Fed trimmed mean and of course core inflation, in my assessment of the likely longer run path for the headline PCE price index. As a result, as long as inflation expectations remain well anchored, close to 2%, modest deviations of any particular measure of inflation around 2% are not a first order concern in my decision framework. In fact, I likely will be even more patient in reacting to small upward deviations, given the committee's move to focus on shortfalls of employment from maximum employment rather than deviations. For those reasons, I supported the action that the FOMC took last week at our September meeting to update the forward guidance to be consistent with the consensus statement for these extraordinary times. Although we've seen the beginnings of a solid recovery, even optimistic forecasts suggest that it will take a while to recover fully from this shock. Evidence suggests that our actions to date have had significant stimulative effects. By providing additional monetary policy accommodation through stronger outcomes-based forward guidance, the committee hopes to quicken the pace of the recovery. Now let's consider some of the implications of the COVID event for banks and for financial stability. Large US banks entered this crisis in strong condition, and the Federal Reserve has taken a number of important steps to help bolster banks' resilience. We took the unprecedented step of prohibiting share repurchases in the third quarter for large banks, while also capping dividends. In addition, we required all banks to reassess their capital needs in the face of continued uncertainty and to resubmit their capital plans. Last week, we released a baseline and 2 hypothetical recession scenarios that will be used by banks and the Fed to assess the resilience of the sector, and we will release bank-specific results from our independent assessment before the end of the year. Non-bank financial firms, especially those engaged in liquidity transformation, experienced acute strains in March. Despite the apparent success of some non-bank regulatory reforms in the United States, such as efforts to increase the resilience of money funds, the Board of Governors again needed to provide significant emergency support. This is why, at the Financial Stability Board, I've put together a senior group of market regulators and central bank governors to develop a holistic review of the March stresses in non-bank finance. We'll deliver that review to the G20 in November, together with a work plan on potential methods to address the vulnerabilities that may amplify stresses in funding markets. In conclusion, the COVID event was an enormous economic shock in the first half of 2020, but a recovery is underway, and the world seems to be adjusting in ways that allow us to address public concerns about the virus without sudden stops in economic activity. A full recovery is still a good way off, however, and risks remain weighted to the downside, so policymakers will need to remain vigilant. Thank you, and I look forward to answering some of Bridget's questions.
Thank you, Vice Chair Quarles. We have collected some questions over the course of the day and appreciate that you'll stick around to answer those. So first up, so we're going from macro to micro here. First up, close to a year ago, I believe it was exactly October 10th, the board released the final rule to better tailor prudential standards and regulatory capital and liquidity requirements for foreign and domestic banks based on their size, interconnectedness, risk profiles. With that regulatory tailoring accomplished, the focus, at least a focus here at the IIB, now turns to supervisory designations and supervisory tailoring. You devoted a speech to the topic of transparency, accountability, and fairness in bank supervision in January of this year, and acknowledged the misalignment between the supervisory portfolios and the tailoring categories. For example, you noted that the LISIC portfolio includes firms in the regulatory tailoring categories 2 and 3, and that some the FBOs in that portfolio had significantly shrunk their U.S. footprint and de-risked their U.S. operations. Recognizing that there has been a lot on your plate between January and now, could you discuss your progress on better aligning the supervisory designations and regulatory frameworks and on bringing more transparency to the composition of the supervisory portfolios?
Certainly. So with respect to the ideas that we've discussed, that I kind of discussed before the COVID event you referred to here, we have made some progress on them. Right before the COVID event hit, we made some important changes with the stress capital buffer and the tailoring package. Obviously, we'll keep monitoring how those changes are working to make sure they're working as intended. And we are picking back up the threads. I'll just say quite frankly that with everything that we were handling starting in about March through the late summer. Some things were put on the back burner, although the burner was not shut off. And we are picking back some of these threads. Transparency in the supervisory process. I think some of you may know we're organizing a research conference on supervision in December together with the Harvard Law School and the Wharton School to focus on exactly this question of bank supervision as opposed to regulation, transparency as opposed to confidentiality. You have competing goods. Are we striking the right balance with respect to them? Due process in the supervisory area as contrasted with the regulatory area, and how should we think about that? And among the other items that I discussed before the COVID onset, but that we're continuing to pursue, again, picking them back up. I still think that changes are needed to the composition of foreign banks in the LISIC portfolio. I think we're going to ask for public input on our thinking about foreign banks and LISIC. Had it not been for the Earth getting hit by an asteroid in March, we would have done that in the spring. Now that we've picked it back up, I expect that will happen soon.
Great, thank you. We opened the conference seminar this morning with a panel of chief bank economists from some of the IIB's member institutions, and I should note that the kudos that group provided to the Fed for both handling the COVID crisis, and then we had a lot of discussion about the monetary policy announcement. I don't know if you were able to watch that, but I should at least pass that along. Okay, turning to another question. Another topic of interest here and abroad has been the Fed's implementation of the remainder of Basel III, the so-called Basel III endgame. You have previously said that the board would look at implementation as a package. Can you share what measures might be in that package? We are particularly interested in the net stable funding ratio, which is rumored to be moving separately and soon. I'm sure you've read recent commentary questioning the need for NSFR, given that banks did not experience any liquidity challenges during the pandemic stress. And in fact, some have noted that had NSFR been in place, it could have actually created liquidity challenges. And second part of that question, you've previously stated your intent that the final Basel III regulatory elements be essentially capital neutral. Does that still stand? How do you measure capital neutrality across the industry, categories of banks? Just interested in hearing about that.
Sure. You've obviously correctly identified the major things that remain in the pipeline. The NSFR as a liquidity measure, and then what we've been calling the Basel III endgame. I guess it's gratifying that you called it the Basel III endgame as opposed to Basel IV. I was told when I walked in the Federal Reserve building I could never say Basel IV. But the Basel III endgame provisions are mostly related to capital. There's the principally among them the operational capital charges and fundamental review of the trading book, a few other elements. Work on all of those was delayed again while we turned our attention to the immediate risks that arose in March. But we are now picking all of that back up and proceeding largely along the lines that we discussed. I think part of your question, at least the implication of your questions, is I have talked about the Basel III endgame as a package. Should the NSFR be included as part of that package? Is that how we're thinking about it? I think the NSFR is it is a liquidity measure. It's a separate measure. It's something as to which we have had a proposal out for a long time, gotten a lot of comment. we've absorbed, and and internally our thinking has evolved in light of that comment. So I don't think, because of its separate character and the separate procedural status that it has, I don't think that it needs to be viewed as part of that final package, which really is a package of capital measures, and ensuring that the capital consequence of those measures is viewed as a whole and remains capital neutral. On the point that you've made about the NSFR, possibly, contributing to market stresses that we saw in March, and could have exacerbated them, or the market stresses that we saw even last September. Yes, we're still in, so September a year ago. I think a lot depends on how it's calibrated, and what we take into account with respect to the effect that liquidity measures may have had on some important instruments. I think that we can calibrate it in such a way that would largely address those concerns and still get the benefits of the measure, which after all has been internationally agreed, and we should live up to that agreement. Now, on the Basel III framework itself, again, the work on that has been delayed by a few months, but is now picking back up with pace. I do think that we ought to look at all of that as a package. We ought to propose that package really sooner than the last time frame that's included in the Basel, in the Basel agreements, so that everyone can see how it all works together. We can see how it all works together and ensure that it's appropriately calibrated. In saying that it's capital neutral, it would be expecting too much. I mean, each of these measures, has a purpose. That purpose is to create certain incentives within the overall capital structure for the portfolio decisions of banks and banking organizations, and that inevitably will therefore have different consequences for different firms, depending on their business models and their particular portfolios. So you wouldn't be able to have it be capital neutral across, on a firm by firm basis, although I don't expect it to have dramatic differences firm by firm. But what we really are looking is that the aggregate level of capital across the industry when these measures are implemented has not been materially increased.
Thank you. And you get that on NSFR. Just one other question. Would you plan to, would there be a new proposal, or would you plan to move straight to the final rule?
Well, since we have, since it has been out for comment, we'll, we would expect to move to a final rule in the next, in the next iteration. It's been out for a long time. As I say, we've gotten a lot of comments, and we have, and we've digested those comments. So I think we're prepared to move to a final rule.
Great. Well, then, speaking of capital, and we might be good to talk about the capital plan resubmissions. So last week, the Fed released the scenarios for the capital plan resubmissions ahead of your self-imposed September 30th deadline. So thank you. And yesterday, when Chairman Powell testified on the Hill in response to a question, he indicated, at least how I heard it, that instead of a blanket extension of the Q3 restrictions on shareholder dividends and stock buybacks into the fourth quarter, the Fed was likely to address that on a bank-by-bank basis. So a couple of questions. First, anything more you can say on dividend restrictions being extended into the fourth quarter? And second, with the stress capital buffer coming into effect on October 1st, is there any possibility that that might be recalculated in response to the resubmissions?
So, okay, so a few things to say about that. So first, So after the June stress tests, we announced some measures to preserve capital in the system, the suspension of share repurchases, and limiting the large banks' dividend payments based on recent income. And we prohibited banks from increasing their dividends. Most banks were able to pay their planned dividend, but those overall measures were put in place given the high level of uncertainty. There's been a combination of restrictions that apply to every bank, the suspension of share repurchases, and then restrictions that are based on each bank's individual circumstances, which are limits on dividends. What was your past average dividend, and what has your income been? We put those measures in place for the third quarter. We're currently considering whether they should be extended for the fourth quarter, and we'll make an announcement on that by the end of September, as I think you know. But that decision can't be informed by the performance of the stress tests that we've just announced the scenarios for, because that test hasn't been run yet and won't be run really until through the fourth quarter, and we'll announce the results at the end of the year. So that can't be the basis of the decision that we'll make on September about bank dividends.
And I should have said Q1, not just Q4, obviously. Sorry.
Right. So, I think the expectation is that, we obviously have done, we've continued, we have supervisor engagement with the banks constantly. We've done analysis of events since the June stress test till now that will inform our decision before the end of September on whether to carry forward those restrictions on share repurchases and dividends. But that is not at the sort of level of bank by bank granularity and precision. It's probably an overstatement to say that the stress tests themselves result in a scientific level of precision, but it's not the same depth of analysis as a full stress test. But that will inform the decision we make about carrying forward the current restrictions. What I am certainly hopeful of is that when the full stress tests are run in the fourth quarter, and we have bank by bank level information that we'll make public as a result of the stress test by the end of the year, that can certainly inform our decision as to what we do on the first quarter. We'll then have a series of very detailed analysis of the current situation. We'll have much more data about how the world is evolving. We'll have more data about how the banking system is evolving. We'll have, three sets of analyses, with three sets of granular firm by firm analyses, the spring stress tests, the two scenarios at the end of the year. And I'm hopeful that can serve as a basis for our returning to regular order. Our desire, obviously, is to get back to regular order where the SCB is the capital constraining measure for firms, as opposed to special rules that we've promulgated in light of the current high level of uncertainty.
Well, we're very supportive of that. And also, we've talked about how with the foreign banks, the dividends, it's different. They're paid to return of capital to the parent bank as opposed to out to shareholders. And, hope that's something that is taken into consideration as you move forward. So the last question that we have is on climate risk. And this is in July, the FSB, which you chair, as you know, announced that it would conduct further work by October of 2020 to assess the channels through which physical and transition risk could impact the financial system and how they might interact. 2 weeks ago, the Cftc's climate-related market risk subcommittee released a report presenting 53 recommendations to mitigate the risk to financial markets posed by climate change. And while the Fed is not an official member of the Network for Greening the Financial System, Chairman Powell has stated that it participates in the meetings, and we note that the Federal Reserve Bank of New York co-chairs the Basel Committee's task force on climate-related financial risks. Select congressional committees have also released reports addressing climate risk as a systemic financial risk. Can you give us any insights into how the Fed might be approaching this topic?
Well, sure. I mean, part of our mandate as a central bank is financial stability, and that includes ensuring that the financial system is resilient against the risks of climate change. I think everyone engaged in this issue knows that there's and agrees that there's still a lot to learn about climate risk, particularly about the impact of that on the financial sector. And I agree with that, which is why at the Fed we're actively engaged in research on climate questions. We conduct a range of research, and we publish all this research on the changing relationship between climate and the economy and the financial system. And as part of that work, we're working to better integrate climate data with our own information on the financial system. As you've noted, we're leading international work on a number of climate-related financial risks in groups like the FSB and the Basel Committee. And we're closely following the work of other financial institutions and regulators to better understand these early efforts around measuring and managing climate-related risks. People often refer to the UK's work on trying to develop stress tests with respect to climate change. I think that's very interesting and worth following and worth doing on their part. It is pretty preliminary. It's not as though they have squared the circle of climate change stress testing. There are a lot of complex and difficult questions associated with that. We're in close communication with them as they work on that. So we clearly recognize the importance of improving understanding in that area. We'll continue to work to do so. Obviously, the response to climate change is entrusted principally to other governmental agencies and authorities, and will. But we will continue to work on understanding these issues and integrating them into our own supervisory processes assiduously.
Well, Vice Chair Quarles, you've been very generous with your time. Thank you again. As always, we're so appreciative of your insights and your willingness to share it with IIB members. And with that, our very first, and I hope last, virtual DC Summit will come to a close. I want to thank all of you for joining us today, as we are all still getting used to this virtual world. Appreciate your patience. I especially want to thank all of our speakers who gave us their time, not just today, but in various prep and test calls over the last few weeks. We cannot express how much we appreciate your expertise. I'd also like to again thank our diamond sponsor, Treliant, our platinum sponsors, CIS Review, Clifford Chance, and Wolters Kluwer. Your support made all of this possible. Thank you again. Everyone stay well and enjoy the rest of your afternoon.